Imagine waking up one morning and hearing that a tiny waterway just 21 miles wide has just been shut down by force. And overnight, it threatens to send the price of oil soaring, crash global markets, and shake every nation's economy from New York to Tokyo. This isn't a hypothetical future. It's unfolding right now in the Persian Gulf, where Iran has declared the closure of the Strait of Hormuz, a choke point through which roughly one-fifth of the world's oil and gas flows every day. Within the next few minutes, we're going to unpack how this tiny channel became the most powerful economic lever on Earth, why its closure could unleash a $7 trillion shock, and what that means for everyday prices, global markets, and your own wallet. But before we go deeper, if you want clear, unfiltered explanations of the forces shaping the world economy, hit that subscribe button and turn on notifications right now so you never miss a video from Bullion Edge. Right away, traders and investors felt the impact. Oil prices jumped sharply, with Brent crude pushing above levels we haven't seen in months, and natural gas spiking even higher. Shipping companies grounded tankers. Insurers withdrew coverage because they won't underwrite war risk in that region, and futures markets went wild within hours of the news breaking. This wasn't an isolated development. It's the culmination of weeks of escalations between the United States, Iran, and several Gulf states. Experts are now warning that if the strait stays closed for days or weeks, we could be staring down a sustained energy crisis, rampant inflation, and even a global recession. To understand why this matters so much, picture this. Imagine the entire global economy's bloodstream is oil. Now imagine someone clamps the artery that feeds nearly 20 million barrels a day into that system. That's the Strait of Hormuz, a narrow channel linking the Persian Gulf to the open ocean, through which more crude oil and liquefied natural gas move each day than through any other route on Earth. It may be narrow in physical width, but it's enormous in economic importance. Around 20% of all global oil consumption, and about a fifth of LNG shipments pass through here every single day. There simply aren't enough pipelines or alternative routes to take up that flow if the strait stays shut safely and securely. Every Saudi barrel, every Qatari LNG shipment, and the bulk of Gulf exports destined for Asia, Europe, and beyond must transit through that narrow passage between Iran and Oman. For decades, this waterway has been a geopolitical flashpoint because whoever controls, or threatens to control, it can influence the flow of energy to the world. That's why global powers have historically kept a close eye on it, and why its closure now has traders, policymakers, and ordinary people waking up in a state of financial alarm. In the earliest hours of this crisis, markets reacted not just to the shutdown, but to fear itself. Oil and gas prices surged simply on the prospect that shipments might remain blocked. Futures markets are extremely sensitive to uncertainty, and traders hate uncertainty even more than they hate higher prices. When supply appears threatened, even for a short period, buyers rush to lock in contracts, pushing prices higher based purely on fear of what might happen. That's why within minutes of the news, oil contracts spiked and gold began to climb as a safe haven asset, not just because of current conditions, but because nobody could be sure how long the disruption might last. Now imagine that disruption lasting not just days, but weeks. Analysts warn that within 3 days of a full shutdown, oil exports from Iraq and Kuwait could be significantly hampered, cutting millions of barrels per day off the market. By the second week, the shortage could deepen and spread to other Gulf producers, with global supply deficits that couldn't be offset by strategic reserves alone. Bloomberg, Reuters, and top banking institutions have all suggested that oil prices could spike well above $100 per barrel, a level that would ripple through every economy on Earth from transport costs to food prices. But the effects wouldn't stop at oil. Liquefied natural gas, which fuels industries and heats homes across Europe and Asia, would see major shortages. Shipping insurance costs have already soared, making every container moving across international waters more expensive. And with supply chains already stressed from previous global disruptions, this added stress could push inflation even higher, slow down economic growth, and strain budgets from governments to households. No country, rich or poor, is immune once a significant portion of global energy supply is thrown into chaos. Some might ask, why can't other routes or pipelines make up for this loss? The harsh reality is that there simply aren't enough alternatives that can be quickly scaled. Major pipelines exist, but their combined capacity is nowhere near what moves through the strait every day. Redirecting oil around Africa, for example, adds time, distance, and cost. And most importantly, it can't be done quickly enough to replace millions of barrels that would otherwise be flowing into global markets. As a result, even if the closure is temporary, the economic shock could be long-lasting. And it's not just analysts saying this. Some of the world's most respected financial minds have openly warned that a prolonged blockage could essentially act as an economic earthquake. They point out that in past crises, even partial disruptions cause sharp price surges. Now, with nearly a fifth of global energy tied up in this tiny passage, the potential for a much broader economic impact is real. Central banks, governments, and major corporations are already reviewing contingency plans, and investors are adjusting portfolios to hedge against what may be months of volatility ahead. What's happening in the Strait of Hormuz right now is not just another headline. It's the kind of event that gets written into economic textbooks years later. When a single decision by one nation can choke off the flow of vital energy supplies to the rest of the world, you begin to see just how interconnected and fragile the global system really is. The Strait of Hormuz may be small in size, but its closure, even temporarily, is worth trillions in market value, future contracts, and national GDPs. Over the next few minutes, we'll look at how policymakers might respond, what it means for everyday prices like gasoline and electricity, and why this crisis could reshape alliances from Washington to Beijing. And as always, stay tuned because we'll break down what this means for your money, not just in theory, but in reality.